Hello and welcome to our continuing coverage at Davos 2023. I'm Shireen Bhan and joining me now is Brian Moynihan of Bank of America. Brian, always a pleasure. Thanks very much for speaking to us here in Davos. Let me start by asking you about the mood here in Davos. It seems like there are different camps. There are some that believe that we're heading into an ugly recession. You don't believe that to be the case. You think that if at all there is a recession, it's going to be a mild one. Why do you believe that?
Well, first, it's wonderful to be here. It's nice to be here in this wonderful setting. And I just came from a lunch with a lot of delegates in the congressional delegation for the U.S. And it's good to see people back together talking, which is just going to be good for the world. So let's put that to the side. In terms of U.S. economy, importantly, our team has a recession, a mild recession, but just today, literally, they pushed it out another quarter. So it's sort of...
They've been doing that, haven't they?
Yeah, they just been, every time I get really sort of out there and talk about it, they push it out a quarter. But we announced our earnings on Friday, and what we told people is, consumers are still spending. It's up year over year, but it's slowed down, which means the Fed is work is getting done. And so our team says an inflation, a recession, mild recession, end of this year. Next year, inflation has tipped over. The Fed will go 25, 25, 25 in the next February, March and May meetings, but not as aggressively. And that they're saying you're seeing the effects of that. So their view is that the Fed now can be a little more balanced in their view. As I look at it from our consumers, they're spending money. They have good money in their accounts. The credit quality of banking institutions and the capitalization liquidity in the U.S. is strong. And if the U.S. is in good shape and the U.S. consumer is in good shape, and employment, remember, unemployment in the U.S. is still very, very low. And in fact, the new claims for unemployment last week was even a very low number and went down again. And that means that people are working and getting paid and wages are rising. Now, that doesn't mean there aren't undercurrents that make it interesting, but the reality is it looks like a mild recession because the Fed has to bring the inflation really under control. They're making some ground, and now they got to push it forward. Yeah,
I think that commentary from the Fed is very, very clear. But you spoke about some of the undercurrents, and right now you're working with the baseline scenario for mild recession by the end of the year. But what could some of those undercurrents be? What are the sort of surprise factors that you would be most mindful of? What are you watching out for?
Well, I think there's two. On the plus side, China reopening creates a lot of activity that wasn't there for a few years, and that will benefit a lot of places. I think a mitigation and not a finished settlement of the energy crisis in Europe provides some good stuff. And then ultimately, I think hopefully cooler minds are going to prevail, and some of the trade discussion that was so tense a year ago is now getting a little more rational, and you're seeing meetings take place with delegations from China and the U.S. trying to work towards cooperation. India has become incredibly important as a provider. So I think those things, if they don't go right, are the same problems as if because they're going a little better right, people feel a little more optimistic. And that's what it's going to be about. It's going to be a trade war escalation. It's going to be a physical war escalation. It's going to be an energy crisis with energy prices shooting up and taking all that money and pushing it away from people's daily spending on something else, which is broader. But right now, we've lived with some of the stuff for a while, and it seems like it's getting incrementally better. But the risk is those types of things. That is the risk. Higher rates will slow down companies. Higher rates will slow down M&A deals. Higher rates will slow down the ability to do leverage finance because the capitalization is completely different. But it doesn't stop them. It just slows them down until people adjust to a more normal rate environment.
This adjustment that you speak of, and we've gone through this era of easy money, excessive liquidity, which really has sort of moved asset classes around the world. As this transition takes place, as this adjustment or normalization takes place, what's the impact likely to be, and when do you expect that to be visible across markets and across asset classes?
Well, the impact of the higher rate environment really was felt, especially in the U.S. and the S&P and the market valuations in the U.S. and around the world last year. And other than certain industries which fared well due to the energy prices or other things, it was kind of nothing went right last year for bonds and equities. And Savita Subramanian, our equity strategist, has basically S&P flat for the year from now to the end of 23. So that's not a really optimistic view, but it's a view that things are going to kind of move around. And then her point that she made last week is within that, there's going to be vastly different sector performance. So that's where the money manager is going to get paid their money and the stock pickers get paid their money. But the reality is I think that the economy is settled in. And so the impact on the ability to do leverage finance deals, the impact on the debt capital markets, that's been felt, and it could, honestly, it could only get better now. It could get worse theoretically, but you've slowed them down to a stop. We went from $2 billion investment banking fees to $1 billion a quarter, as did all our peers, and so you've seen a slow down way below where it was in the 17, 18, 19 era, and so it ought to come back. And so I think those kinds of impacts from rates and rate structure and higher rates, the housing market in the U.S. has tipped down, but it's still higher than it was in 19 by a lot. So those types of impacts are felt. And I think the question that the Fed really was pushing people is to understand it may take longer than people think to hold them there. So there's a little bit of debate on when do they, quote, cut rates to take that a little bit of a tourniquet on the economy to slow it down off. And I think people are underestimating it. It may take longer because the strength of the underlying economy is hard to slow down.
You know, you talked about India and the resilience that we've seen in India. What's the team back home telling you about the India story at this point in time?
Well, Kaku, our leader there, is always telling me it's a great place, and it is. I mean, the country, we predict to grow at 6% for this year, which is probably one of the largest economies growing at that growth rate. And, you know, it's been interesting because even with a country that imports a lot of its, energy resources, has been able to fight the battle and get those in a rational way, that it's proved well. But the talent and the capabilities of that country are well known, and frankly, you know, it's another place to provide goods and services to the world, and the normalization and the change in laws that make outside companies easier to invest and work with, I think are all going to hold in good stead for the country.
But with a higher interest rate environment and liquidity drying up, in terms of flows to emerging markets like India, what do you anticipate?
I think they've gone through the transition now, etc. There's no question the impact of higher rates in the U.S. has a not great effect to the borrowing costs of the rest of the world, and that is known. But I think the Fed and others are very mindful of that impact. But the worst thing would be to have inflation in the U.S. out of control, because that would then require them to even go higher. So I think as you see it, I think that's where people are sort of used to the rate structure now. It'll normalize back to a positive sloping rate curve, and as it does that, I think some of the pressures will come off. But there's no question that, you know, people borrow in U.S. dollars, and when the dollar strengthens because its interest rates are higher, they got to pay more money back in the local currency. That's a tough thing, and that's why, frankly, our team does a great job at hedging our corporate clients around the world, and that's one of the abilities we provide for them. India companies that we work with hedge that risk, so you don't have that risk come eat you up later on.
You know, I've been talking to CEOs here, and everyone's saying that they are taking measures or steps to try and mitigate the risks if the world does move into a recession. What are you doing at the bank at this point in time to cope with the current environment?
Well, we're no different than anybody else. So we've had this inflow in net interest income, you know, spread revenue, so-called, in the banking system, which gave us a lot of profit lift, or at least put it back to where it was pre-pandemic. That's the thing. So what do you do then? Well, we have a theory we call responsible growth, and one of the principles is to drive operational excellence. And so we're managing headcount. At the end of the day, our company is a wonderfully talented group of people, a bunch of computers that they operate with in the buildings to keep them dry. And so this customer base depends on those people and being good. So we always are in the market hiring people, but in times like this, you're a little more careful about your hiring to bring the headcount in line with your productivity capabilities. And then you work, we spend, you know, $500, $600, $700 million a year on more productivity, what we call operational excellence, simplify and improve, ideas of taking out work which isn't beneficial and redeploying that money. So what you're hearing across the board from our clients is more care on hiring, being a little more careful on investments in the future if the payback's not more assured, and then also just, you know, the real estate that they own and stuff, trying to sort out the return to office and work from home. All those dynamics has got on their minds. But at the end of the day, most of these companies like us, it's the talent they have. And then as the turnover rates and stuff have slowed dramatically in the U.S., people are now pulling back on the hiring. There are certain industries that are doing layoffs and stuff. That's more because the business model is different. But in general industry, people are just pulling back and being a little more careful.
So you don't see any large-scale layoffs across sectors, just a slowdown as far as hiring is concerned?
Yeah, we've already slowed down our hiring. So this time last year, we had to hire 4,000 people to keep up with the people that leave. Now we only have 2,000 people leaving, just to give you a sense of how fast it came down. So you only need to hire 2,000 to keep up with it. Well, that's a whole different hiring practice. Now, you know, even with a 10% turnover rate, we have to hire 20,000 people just to have neutral head count. So we're out there hiring all the time, and, you know, new people, you know, experienced people, and everything in between. So, you know, but most companies are like that. What you do is you aim to keep that head count right in line, a little tougher on managers and overhead and things like that. It's just the way good managers manage.
I also want to understand from you where things currently stand as far as your digitalization plans are concerned, and whether you're upping spends there, because you talked about enhancing productivity as well. What's the plan there?
Well, if you think about it in terms of the various businesses, because they're different. So the huge digital aspects of consumer business is huge. Now we have 65 million digital people download the app, and we have 55 million active users, and we have 35 million active mobile users, and they do 1 billion logins a a month now, so it's hugely digital. Like half our sales are digital. Our Erica has hundreds of millions of interactions, which is artificial intelligence, virtual assistant for people. Our Zelle, which is mobile payments, is growing very quickly. So the business is largely digitized, but you have to remember the key thing for our customers is they want to meet people once in a while and have issues that people can solve. And those are still different than the machine and their ability to operate the machines. And so we have 3,900 branches that are very important. We used to have 6,000 branches. So that's the change that's taken place. When you go to the wealth management business, 85% of the customers are digitally enabled. When you go in the corporate business, all digitally enabled and all coming at us digitally, and checks and things like paper going out of the system. So it's different. We'll spend, next year, if you look across the business, it's probably $500 million or more just on more digital implementation across all the business. Parts for efficiency in the company, but a lot of it's for customer capabilities.
I want to talk to you about what we're seeing happen as far as cryptocurrency market is concerned. It hasn't been a good year there. Do you expect more pain? And do you think that, the trust deficit now is just too high as far as this asset class is concerned?
We've always said the digital currency part of this was for other people to talk about. It's not something we need. The banking system we send trillions of dollars digitally every day. Way more than half of our consumer transactions are digital today. We never quite understood what the value was. The blockchain, we have a couple hundred patents issued on it. We understand that, we're using it. We're trying to figure out how to use it. That's different. I'll let other people. You have lots of experts up here who can make the case. We just stayed away from it.
Brian, always a pleasure. Many thanks for joining us here on CNBC-TV18 in Davos.
Thank you.
Well, we will take a break here. The conversations continue at Davos 2023. We're back in a moment. Stay with us.
Co-presented by Bank of Baroda.